Gen Digital beat consensus across the board for their Q1 fiscal year 2027 earnings. Adjusted EPS came in at 71 cents, beating the 69-cent estimate. Revenue hit $1.34 billion, so that's an 11% adjusted year-over-year increase. Management aggressively raised full-year guidance, too, pushing the top end of their revenue projection to $5.475 billion. And yet the market's reaction was, well, completely muted. The stock essentially flatlined, closed the regular session at 28.09, and barely budged in after-hours trading.
Yeah, the divergence between Gen Digital's fundamental execution and, the stock price action, it's basically the defining story of this quarter. I
Yeah.
mean, we are looking at a company delivering just a textbook beat and raise.
Right.
They're posting the fastest revenue growth since the merger that formed the current entity, out of Norton, Avast, and LifeLock. And institutional investors just responded with a collective yawn. The financial mechanics driving that hesitation are really what make this earnings report so critical to dissect.
Exactly. Which is why our mission for this deep dive is to unpack that underlying momentum, the structural shifts within Gen Digital's business model.
Right.
We're pulling from their Q1 earnings call transcripts, analyst notes from Barclays and Wells Fargo, some financial data sets from Zacks and MarketBeat, and a really fascinating legal breakdown from IP Watchdog regarding a high-stakes patent battle. But, okay, let's unpack this. We need to start with the sheer scale of their footprint, because the paid customer base just crossed the 81 million mark.
Which is massive.
It is. That represents an addition of 5 million paid users year over year. For a mature, highly saturated market like consumer antivirus and identity protection, adding 5 million net new paid users is an absolute anomaly.
It is. And the critical phrase management utilized in the earnings call to contextualize that growth was a structural step up.
A structural step up.
Right. In the software as a service ecosystem, a structural step up implies the fundamental unit economics of the business have improved. They are not merely brute forcing top line revenue by spending heavily on marketing to acquire new users.
Because that usually just kills margins, right?
Exactly. It invariably destroys margins due to soaring customer acquisition costs. Instead, what they're doing is systematically increasing the lifetime value of the users already inside their ecosystem.
Okay, so it requires a shift in perspective. You really have to stop treating Gen Digital as just a vendor of a single software product and start viewing them as a platform ecosystem. It's kind of like, think of their business model like a municipal utility grid.
Oh, that's a good way to look at it.
Right. Once the physical pipes and wires are connected to a house, the marginal cost of delivering an extra gallon of water or, a kilowatt of electricity is incredibly low.
Right.
Gen Digital already has the billing relationship. They have the localized software client installed on 81 million devices. The revenue acceleration is coming from routing more diverse services through those existing digital pipelines.
Yeah. And the breakdown of those services reveals a very deliberate dual-engine business model. It's designed to maximize that utility grid you just mentioned. So the first engine is the cyber safety platform.
Which is the legacy stuff.
Right, that houses the legacy Norton and Avast products. In Q1, this segment generated $846 million. That represents a highly predictable, totally stable 4% growth rate. But the vital metric for analysts isn't the top-line growth of that segment.
It's the margin.
Exactly. It's the operating margin, which sits at a staggering 61%.
Which is huge. That 61% operating margin is the financial baseline. It basically acts as the high-yield engine funding the aggressive expansion of the rest of the company. It allows them to scale their second engine, which they categorize as trust-based solutions.
Right.
And this encompasses LifeLock, MoneyLion, the engine marketplace. This segment generated $490 million for the quarter, but it grew at an explosive 24% year over year. The operating margin is significantly lower. It's at 30%, but the top-line expansion is undeniably the catalyst for the entire company right now.
The mechanism driving that 24% growth in the trust-based segment, it requires a closer look at user psychology and interface design.
How so?
Well, it is not just about placing a static banner ad for a personal loan inside an antivirus dashboard. Gen Digital is actively leveraging telemetry and behavioral data. When their software detects that your personal information was found in a dark web data breach, or say that you are engaging in higher-risk browsing behaviors, they are perfectly positioned to offer adjacent financial protection services.
Precisely at the moment of peak user anxiety.
Exactly, when you're most likely to buy it.
But I do want to push back a bit on the natural fit of those adjacent services. It still feels, structurally disjointed for a company rooted in stopping malware to be actively selling financial wellness and facilitating cash advances.
Yeah, I hear that.
I mean, the jump from quarantining a Trojan virus to acting as a lead generator for consumer credit seems like a massive leap in brand identity. Why not just focus engineering resources on stopping the next generation of malware?
Because the threat landscape has fundamentally altered that brand identity. I mean, in an environment dominated by automated, AI-driven threats, the distinction between a cybersecurity breach and a financial crime has essentially evaporated.
That's a fair point.
All right. Consider the mechanics of synthetic identity fraud or, like, AI voice cloning. If a bad actor utilizes an AI voice clone to bypass your bank's biometric security and authorize a wire transfer, that is simultaneously a cyber failure and a direct financial loss.
Yeah, they're the same thing now.
Identity protection, device security, financial remediation, they are now entirely overlapping circles on a Venn diagram. Gen Digital recognized that mitigating the software vulnerability is really only the first step. Shielding the user's financial assets is the ultimate value proposition consumers are actually willing to pay a premium for.
So the strategic value of their engine marketplace becomes obvious in that context. It functions as a comparison shopping engine for financial products, personal loans, credit cards, mortgages. Historically, acquiring a user for a financial marketplace requires astronomical digital ad spend.
Astronomical. You're bidding against massive retail banks on Google and Facebook for visibility.
Exactly. But Gen Digital entirely bypasses that customer acquisition cost because they already own the user's desktop and mobile screen.
They have zero-cost distribution built directly into the operating system level of the device. When a Norton alert naturally triggers concern about identity theft, Gen Digital can immediately pivot that concern into action. They offer a credit lock through LifeLock and subsequently credit monitoring or debt consolidation tools through their marketplace.
And the conversion rates on those have to be huge.
Magnitudes higher than a cold digital ad because the recommendation is originating from a trusted security protocol the user already relies on.
Which brings us to a specific data point in the financials that highlights just how deep they are into the consumer finance sector. In this quarter alone, Gen Digital facilitated $1.193 billion in what they categorize as Instacash advances through their financial platform.
Over $1 billion, right?
They are operating at the volume of a mid-sized consumer lender, pushing over $1 billion in cash advances in 90 days.
And generating that volume proves they have successfully transitioned from a utility software provider to an active facilitator of financial transactions. However, that volume comes with immediate exposure to financial market mechanics that traditional software companies rarely deal with.
Like the mark-to-market loss.
Exactly. The earnings report noted they recognized a $60 million loss on the mark-to-market and sale of these advances.
Okay, let's break down that mark-to-market mechanic for a second. When Gen Digital originates or facilitates these cash advances, they hold them on their balance sheet before bundling and selling them off to institutional buyers, or securitizing them.
Right.
If prevailing interest rates shift, or if the perceived credit risk of the consumer pool changes while those advances are just sitting on Gen Digital's books, accounting rules dictate they have to adjust the paper value of those assets to reflect current market prices.
And that $60 million loss reflects that fair value adjustment. It really highlights the inherent friction in their dual-engine model. Management is trading the predictable, high-margin, recurring revenue of software subscriptions for the volatile, transaction-based revenue of consumer finance.
It's a trade-off.
It is. The ultimate revenue ceiling in finance is much higher, but the execution risk and the exposure to macroeconomic headwinds are infinitely more complex.
We need to connect that complexity to the stock's performance, going back to what we said at the top. Analyst sentiment remains firmly entrenched at a consensus hold. Barclays raised their target slightly to $32, and Wells Fargo bumped theirs to $28. But we aren't seeing the institutional upgrades or the post-market rally you would typically expect from an 11% top-line beat and raised guidance.
And the hesitation from institutional analysts centers entirely around the mathematics of the margin mix shift.
Explain that.
So, the overall operating margin for Gen Digital remained remarkably stable this quarter at 50%, which allowed them to generate $430 million in free cash flow. But institutional models project years into the future. Analysts are looking at the 61% margin legacy business growing at a very slow 4%, while the 30% margin trust-based business is surging at 24%.
The math on that trajectory is inescapable. If the lower margin segment continues to grow 6 times faster than the higher margin segment, the trust-based revenue will eventually become a much larger slice of the total revenue pie.
Right.
And as that happens, the blended overall operating margin of 50% will inevitably be dragged downward. Wall Street isn't valuing the company solely on total gross profit dollars increasing today. They're penalizing the stock for the percentage decline in profitability they see coming in the future.
Exactly. Institutional investors are demanding proof that Gen Digital can achieve economies of scale within that trust-based segment. They want to see the architecture scale efficiently so that the 30% margin expands as the user base grows.
Yeah, that makes sense.
Until management proves that 30% isn't a hard ceiling for their financial services division, the stock price will likely remain constrained. The company is currently executing a $50 million fiscal 2027 restructuring plan, actually having already incurred $32 million, mostly in severance costs.
Oh, wow.
Yeah, that indicates management is acutely aware of this Wall Street pressure and is actively cutting legacy overhead to defend that 50% blended margin.
So by reducing fixed headcount costs in the high-margin cyber safety segment, they can attempt to offset the margin compression caused by the rapid growth of the trust-based segment. It creates a fascinating divergence in the investment thesis depending on who you are, right?
Absolutely.
For a retail investor looking for yield, you see a company throwing off massive amounts of free cash flow, aggressively buying back shares to artificially support EPS, and raising its quarterly dividend to 12.5 cents per share. But an institutional growth fund sees a software company diluting its premium margins by wading into the capital-intensive world of consumer lending.
Spot on. But while analysts were building models to debate the long-term implications of that margin compression, Gen Digital's legal department was actively neutralizing an immediate existential threat to their free cash flow.
This is wild.
A significant portion of the Q1 narrative is defined by a legal victory that doesn't appear on the top-line revenue metrics, but fundamentally protected the balance sheet.
Let's transition to the $185 million patent lawsuit. Wiping nearly $200 million in liability off the books in federal court is just as impactful to the immediate bottom line as launching a new product line. This involves the U.S. Court of Appeals for the Federal Circuit, the CAIC, which recently reversed a district court judgment against Gen Digital concerning the Norton brand.
So the plaintiff was Columbia University, and they were alleging that Norton infringed on two specific antivirus software patents, numbers 8,601,322 and 8,074,115. It is really vital to note this was not some frivolous filing dismissed in the early stages of litigation.
Right, it went all the way to a jury.
Columbia successfully argued their case at the district court level and secured a massive $185.11 million jury verdict for willful infringement.
For context, $185 million represents nearly half of the company's free cash flow for the entire quarter. The scale of that verdict was heavily influenced by the concept of willful infringement. In patent litigation, if a jury determines that a defendant not only infringed on a patent but did so knowingly and deliberately, the judge has the discretion to multiply the initial award by up to 3 times.
Yep.
It turns a standard licensing dispute into a balance sheet destroying event.
But the appellate court completely struck down this jury verdict, relying on a critical precedent in patent law known as the Alice framework. Specifically, they ruled based on Alice Step 1. The court determined that Columbia's core claim was directed at an abstract idea, which is explicitly ineligible for patent protection under U.S. law.
So, the legal framework stems from the Supreme Court's Alice Court decision, which established a 2-step test for software patents. Step 1 asks if the patent's claims are directed at a fundamental abstract concept, like a mathematical algorithm, a fundamental economic practice, or a method of organizing human activity.
Right.
Columbia's patent involved using multiple distributed computers to simultaneously scan for malware to increase efficiency.
And the underlying logic of the court's rejection requires understanding how process optimization works. Taking a known process and simply executing it in parallel isn't an invention. It is literally just an abstract concept of efficiency.
Let's contextualize that without the legal jargon. Imagine a massive logistics hub trying to process millions of packages. The traditional method is having one massive conveyor belt scanning barcodes sequentially.
Okay.
If a logistics manager says, hey, let's build 3 parallel conveyor belts to scan the packages at the same time to process the volume faster, they haven't invented a fundamentally new type of scanner. They have simply applied the abstract logistical concept of parallel distribution to an existing physical process. Columbia took the known process of scanning byte signatures for malware and applied it across multiple computers. The court concluded that achieving efficiency through parallel processing is a generic computer function. It's not a patentable invention.
The CAFC even noted that Columbia's own technical experts conceded the emulator technology they were using was conventional. The only purported innovation was the application of multiple computers to perform the conventional task faster.
Which doesn't cut it.
No, federal courts have consistently held that you cannot salvage an abstract idea simply by adding the instruction to do it on a computer, or in this specific instance, do it on multiple computers concurrently.
But the legal breakdown from IP Watchdog highlighted that the appellate court remanded the case back to the lower court for Alice Step 2. So the $185 million judgment is vacated, which removes the immediate liability, but the litigation itself is not entirely dead.
Right. Alice Step 2 requires the lower court to determine if the patent claims contain an inventive concept sufficient to transform the abstract idea into a patent-eligible application. It asks if there is an element in the patent that is not well understood, routine, or conventional in the specific field of cybersecurity.
And Columbia is focusing entirely on a very specific technical element for this second step. They are arguing that their particular model of function calls constitutes that required inventive concept.
Yeah, and to understand their technical argument, you have to look at how modern antivirus software actually analyzes suspicious files. Instead of just looking for known malicious code signatures in a database, the software places the unknown, potentially dangerous file into a safe, isolated virtual environment.
A sandbox.
Exactly, called a sandbox. It then allows the file to execute and observes its behavior in real time. This is done by monitoring the function calls, the specific request the program makes to the operating system, like asking to delete a system file, encrypt a folder, or access the registry.
Columbia claims their specific method of comparing the expected behavior of these function calls against the emulated behavior within the sandbox is uniquely inventive.
Yes.
The appellate court essentially ruled that they didn't have enough factual evidence in the record to declare that specific sandboxing method conventional or inventive as a matter of law. So they just sent it back down to the district court to figure out that single, highly technical software architecture question.
And the broader takeaway here illustrates a systemic vulnerability for the entire technology sector. I mean, think about it. A company can optimize its SaaS metrics, they can execute flawlessly on cross-selling high-margin financial products, aggressively manage their margin mix through targeted restructuring.
Do everything right.
Everything right. Yet a single abstract software concept held by a university or like a patent holding company can navigate its way to a sympathetic jury and instantly generate a 9-figure liability. Navigating these intellectual property gauntlets is just a fundamental, unavoidable cost of doing business at scale in the software industry.
It really is.
Yeah.
Synthesizing the data from this quarter gives us a very clear picture of Gen Digital's current trajectory. They have successfully accelerated their financial flywheel by leveraging their high-margin cybersecurity ecosystem to fund and distribute high-growth financial tools.
Yep.
They are monetizing the telemetry and trust of 81 million users at an unprecedented scale, moving over $1 billion in consumer credit volume. Simultaneously, their legal division navigated a complex intellectual property gauntlet, neutralizing a massive $185 million threat that could have severely impacted their cash flow narrative. They beat the estimates, raised their guidance, and actively protected their balance sheet.
The broader implication of their strategic pivot into finance is what really merits further scrutiny moving forward, though. As cyber threats become increasingly automated and sophisticated, Gen Digital is positioning itself as the ultimate, all-encompassing guardian of both our digital and financial lives.
Right.
They want your antivirus, your identity protection, your VPN, and your cash advances consolidated into a single unified ecosystem.
And the convenience of that consolidation is obvious for the consumer. But it raises a deeply critical question. As we willingly merge our entire digital footprint and our financial infrastructure into a single platform for the sake of safety and seamless integration, are we inadvertently engineering a catastrophic single point of failure?
That's the scary part.
If one master key turns every lock in your digital and financial life, what happens on the day that platform itself is compromised?
It is the ultimate paradox of modern cybersecurity. The deeper the integration required to effectively protect the user across multiple vectors, the greater the systemic risk if the outer perimeter ever fails.
That is a necessary reality to consider as these centralized platforms continue to expand their reach into consumer finance. Be sure to follow the show for daily earnings coverage to stay ahead of the markets and understand the mechanics driving the numbers.